Okay, so I will probably take care of the rest of this evening, or with this technical analysis on cryptocurrencies and the Dow theory. So the Dow theory, you've probably heard of it before. It's about the stock exchange, the Dow Jones, the biggest indicator for stock exchange, and we will relate that to cryptocurrency. So why do we choose Bitcoin as analysis subject? Because the trend of Bitcoin price has a very high correlation with the crypto market, and the performance of Bitcoin is one of the most important indicators. And so instead, not just that, Bitcoin is one of the highest trading volume cryptocurrencies out there. So it itself can become like an indicator, like Dow Jones. Dow Jones is more like a collective amount of stocks and companies added together as an indicator. And so below the Bitcoin chart, you can see like the fluctuation and the trading volume is really high. So that makes it really important and really easy to analyze subject. And next one, we shorten technical analysis as TA, not teaching assistant. But so we predict Bitcoin returns with the technical analysis. But I wouldn't say it's 100% accurate, or else we wouldn't be here. So the most cryptocurrencies has no widely accepted fundamentals. So not every Bitcoin or not every cryptocurrency is like Bitcoin. They're actually very different. So some cryptocurrencies are made of foundations with a smart contract. Some are made of stable coins, and they're all very different. So there's no standards for what cryptocurrency should look like. Whereas Dow Jones and stock market, they have a standard because what's the American thing? Okay, never mind. So whenever they need to make a stock go public, they need to go through the necessary processes. So they actually have a fundamental, and they have to pass the criteria to actually be able to release their stocks to the market. But cryptocurrency, you can just release it to any place, or I could just make a cryptocurrency and ask you to buy it, and then that would be a trade, And so investors rely on its price and trading volume curves. So basically, you're not looking at anything like the company profitability, the company ability, or the employees. You're just looking at, okay, today is $5, tomorrow's $10, so it's got to be a good cryptocurrency, right? But sometimes it could just be me trading to my friend. I'll sell you for $10, and you buy it off of me for $10. So now my cryptocurrency is $10, which is why there's very the price is kind of skeptical a lot of times for cryptocurrencies, and so the investors sometimes are sketchy when they invest in cryptocurrencies, because if the trading volume is not large enough, it could be just me and my friend trading and increasing the price. So that's why the trading volume matters more than anything in this situation. And the investors use these two factors to see where they buy it, where they sell it. And we will tell you about actually where to buy and sell according to a formula, which is the moving average we will talk about. So the third point is it's a challenge to construct a fundamental method applicable for digital assets, because they're in all sorts of forms, and they have no governance, they have no institutions that back them up. So if today my cryptocurrency closes, I do not have to go to a government to file bankruptcy, because it's not really a company, so I don't really need to file anything. And sometimes even the biggest cryptocurrencies could just be a shell, like a five-man group just talking like, hey, let's make a cryptocurrency. I'll trade 1 million to you, you trade 1 million to me. And then the volume is huge, but nobody's really trading. It's just 3 people. You can't really see the amount of people trading. That's also one of the problems. So we have the imperfect market conditions, which I already mentioned. And it'll continue for several years because the government is not except China, most governments are not getting into cryptocurrencies yet. Okay, so the theoretical foundation of technical analysis, the Dow theory. We're going to talk about how the foundation for the stock market theory came up first, so we can then apply that onto what we will analyze Bitcoin. So Charles Henry Dow, who developed a series of principles for understanding and analyzing market behavior, which later became known as the Dow theory. Well, groundwork for many technical analysis. I mean, there's a lot more analysis on stock market, and each company. You can, if it's top 10 biggest company, you can go with like their own analysis. They will analyze their company for you. They'll be like, we earn money here, there, here. And if you just go into their annual return spreadsheet or to their annual report of like 100 pages, they will tell you exactly how they're making money and how they're doing. So sometimes you don't even need to look at these theories. But Bitcoin or in cryptocurrency, they really need to look at these analysis because they have no foundation. You cannot go into a big cryptocurrency company and ask them for their annual report. They will tell you they don't have anything. And so, which is why we use this as our basis to analyze Bitcoin instead of all the other bases which you see for the stock market. And the trends exist that until definitive signals prove that they have ended, which is, the basic tenets of Dow theory. And the third part, we're going to introduce what we call the moving average, and it's one of the most well-known trend-following indicators. It's like, let me try to articulate a way to explain this. So basically, it highlights the main movement of the market, and it'll help investors pick the right time to actually invest in the market. So the problem with a successful company or a successful cryptocurrency is you will see you will look at the indicators with the huge indicators. Like, for example, today is 2019. We look at 2018, seeing that the company was maybe net worth of $1 million before. Now it's $100 million, so that's 100 times more. That means the company must be really successful. But you don't know where to invest. For example, there might be like 1 month where it was worth, each stock was worth $50, and then you're like, okay, so it's got to be really good because it was worth $30 a while ago, so we buy it at 50, and then it went down to 40. But then it will later go up to 100. You just didn't know that it will. So that's why the point of purchase is really important, and that's where the moving average help us indicate the possible buying and selling points on the trend. So a lot of people are optimistic about the future of Bitcoin, or the PowerPoint says that, but I'm not. But it's a long-term moving average strategy of like 200-day, and being a more flexible option. So we have a simple algorithm. You don't really have to know the algorithm technically, but I'll try to explain it to the best of my ability. So it's a simple trading rule for a simple moving average. So we have the long-term and short-term one. So T here would indicate the time, and N would indicate the section. So in terms of short-term and long-term, here we have some sort of chart, if everyone can see that. So you buy it. Give me a second to think how to explain it best. 5 to 10. So Okay, so for example, we cut into days. So today is let's not say today. Let's say October 3rd, and we cut it in. Cut 5 days before that and cut it into 5 pieces. That we call this as the short-term average. And then we cut another one really far away, and then that divide it into sections and call that the long term. And we average that into a number. So for example, the average of these 5 numbers turn out to be 30. And then the average of all these numbers that we cut, maybe 20 or 30, the average is 40. Then we will know the long-term moving average and the short-term moving average. So whenever the short-term moving average is larger than the long-term moving average, it's the time to buy, because it means like in this amount of time, very short, like 1 month, this company has a higher price for their stock than the whole 6 months. That means it's good to buy right now, because this month is the best, and it will continue. It probably continue to be better. That's the theory, at least. And the time to sell is when the moving average for the short term is smaller than the long term. So if this whole month's average for each section we cut, maybe 1 day, 2 day, or 1 week, it's smaller than the whole long term, then it's time to sell because the past 6 months they've all had better numbers than this month. So it's probably time to sell. But this is just the big theory of it because in real application, you cannot just determine from the basis of this purely. You need this and other indicators. But we will just teach this part for now. Let's get into the papers that mention moving average, which is like thousands of paper, but this is one of them. So Brock Luknovsk, whatever how you pronounce that. So the guy and this other guy made a simple technical trading rules and the stochastic properties of stock returns, and they show that the tradings are based on technical indicators, especially the moving average of prices can be profitable in the stock market. So for example, if we take this theory and apply it on a random stock, like you just think about random stock, Facebook, think of Snapchat or something. You apply this and then you realize you're not actually making money. It's not the theory's fault, it's because your sample size is too small. You need to go into more. Like, for example, I take 500 companies and apply this theory onto all of them, then possibly more than 50% would be making money. But that really depends on the amount. So this theory is just the foundation. We're not talking about the complex trading of like big data analysis of trading. Like according to the professor, the big data trade analysis for trading are mostly hoax. They're not very helpful because the data they collected do not collect, for example, news reports and things like that. So, for example, today, if I just look at this and then I go to invest a company, I might not know that the CEO had quit the job because he didn't like the company, and the company's price went down 25%. This actually happened to Puma, which you might know, the clothes brand company. The CEO. The CEO was fired from the company, and the new CEO replaced it, and the stock went up 15% instantly. So how can this account that? It cannot, which is why we have not had a system which just beats everyone and just, okay, well, the professor's back. 你刚刚好可以讲这个 Okay, so we're looking at the Bitcoin trend prediction data to see if the price is above the moving average. We consider the trend is up. In the other hand, when the price is below the moving average, the trending is going down. I mean, I don't have to say that because you can see it on the chart. But if we don't have a chart here and we use the numbers to calculate, this would be what the chart would appear to be looking like. So the charts actually don't happen first. The calculations happen first. That's why you see this. But technically, we should do the calculations first, then show you the chart. I actually have no idea what this is, so that the teacher can go into this later. And how we evaluate the performance of TA indicator. Sorry.
Very good talk. Thanks. Sorry. It's a tough day today. Okay, so okay, going back to this slide. Thanks.